What we haven't addressed yet is the funding side, the investment climate. What are the trends in startup investments? How about valuations? What about investors' preferences in stages, sectors, technologies, applications? And how does that vary across Europe? McKinsey's Christian Irlbeck will tell you all about it. Please give Christian a big hand.
Thank you for having me back here. It's so great to meet many of you in the last two days here. I hope you not only had a wonderful lunch break, but also a wonderful 1.5 days so far here in Munich. Today, as Roger said, I would like to talk a bit about what we see on the global macro landscape and how it affects the funding market and also the innovation ecosystem. So, when we look back a few years, I think many of us, when we reflect through the years 2010, 2011, and so on, there were years where we don't recall any major changes in the world. And then the last 2 years happened. And we arrived into a new normal, as often quoted. And today, I want to reflect a bit on what is happening currently in the world. But let's not forget, when we read the news, it might be quite depressing, and news is often quite pessimistic. We analyzed it also, so you have seen nice analysis. Apocalypse is much more common now than progress, and the end of the world was forecasted quite often. 500 years ago, a few centuries ago, and probably most recently around year 2000. And many are saying, the past was always better. But is that really true? What does the data say? Well, the data says clearly it's not true. So we took a very long view back, 200 years, 2 centuries, and comparing a bit what happened in the world on a global scale. And what you can very clearly see is we are, as a society, more prosperous than ever before, with very clear acceleration also in the past years. And we are also smarter, more healthy, and less poor on an individual level. So let's look at the last 2 years. There, the picture looks a bit different, and it feels very new. And many of us are wondering, have we ever been in times like this before? It started with COVID in 2020 that affected many of our life and livelihoods, family, friends, colleagues, and many of ourselves as well. We then had beginning of the year and still have the war in Ukraine, one of the first wars in Europe since quite some time, affecting us directly and indirectly, stretching our supply chains. And of course now we have a phase of very high inflation, increasing interest rates that are pressuring society. And did we ever have a crisis like this before? Well, yes, we had, but it's still quite a while ago. So if you look back to the 70s, there was the oil crisis. This is quite comparable to the situation we are having now, because the more recent crises like .com, like the global financial crisis, they were a demand crisis, which basically means there was high uncertainty, people kept their hand on the pocket and didn't spend the money. But it was generally there, products were there, and when the uncertainty went away, also demand snatched up again, and the economy recovered quite quickly. Now, we are in a different situation. The supply chains are stretched, they are partially broken, money is also not there anymore, and the outlook is much more uncertain. And we asked ourselves, how does society feel? How do consumers in the market feel about that? And did an extensive study. And the answer is, while COVID, of course, was a clear shock, the situation now is even worse. So since COVID, we did a survey with more than 1,000 respondents per data point on how confident people feel about the economic recovery after the crisis. And we plotted a bit the delta between those who are very positive about it and those are, on the other hand, quite negative. And what you see is that while it fluctuated and got a bit better last year, we are now at a low point and people are quite concerned about it. Why are they concerned? We also ask, and the message is also quite clear, and that's also across Europe. So high prices, rising prices, are the number one concern. Of course, COVID and the war are also on top of people's minds, but the increasing prices, if you compare it also across wealth spans, not all of us in society are as fortunate as many of us here in the room, putting really high pressure on households in the next weeks and months and the years to come. So with this macro view, we ask ourselves, what does it actually mean for the funding market, for the VC ecosystem, and finally also, of course, for many of the great companies we have in the room today? We are looking to performance of the funds, we are looking to volumes and valuations. So let's take a look back on the last 20 years. How did VC do in terms of performance? And we actually do see surprisingly little effects of crisis on VC performance. While the crises have been different from an economic point of view, they still were a clear crisis to the financial ecosystem. And VCs have managed so far to come out quite well with a very clear acceleration also over the last years. If we look to funding volumes, the picture looks a bit more mixed. So if you look into the European IPO market, it looks very dramatic. So you see deals have gone down by more than 60%, volume has gone down by more than 90%, so it looks quite bad in the overall society. But is that really true? Well, that depends on the perspective. If you just look at the funding volumes, the message is actually Europe is quite strong and quite stable as compared to the US. So while in the US, you actually see it, the funding volume in the VC ecosystem has dropped quite substantially. Europe is very stable, and money is still there. It's even expected that funds this year will have a record year in terms of the funding that they secure from their LPs, and there is a lot of dry powder to be invested in the coming months and the next years. When we look on the valuation side on tech overall, we do see quite a clear picture. So while the Nasdaq Composite Index is going down, some newspapers even depict the end of the tech decade. Not sure if I would be so dramatic, but there is a clear trend that there is pressure on valuations. Interestingly enough, it's not that all valuations or all sectors are going down. So we looked a bit, how did other sectors do in comparison to the Nasdaq Composite Index? And while some sectors like clean tech or aerospace and defense after the war are not surprising, it's actually quite positive to see that insurance is also one of the winners. So the insurance industry overall being quite resilient also in crisis time. However, that's not entirely true if we look to insurtech only. There also the picture is quite clear. We depict a few of the public insurtechs, mostly from US, and you can see drops from 50, 60, even 90% plus in the recent months. And this, of course, started in the public markets where valuation changes spread quite quickly and arrived also to the private markets, where we do see the phenomenon that currently many of you are not in the funding market anymore, try to wait until the climate is getting better and avoiding down rounds. The question is a bit, how did we come to this? What drives this valuation downturn? So there are several macro factors, that is true. There are increasing interest rates that diminish the value, of course, of future cash flows. There were very high valuation levels before, and there are multiple also uncertainties in the market. But what is also true is that many investors woke up a bit, and the hype on pure insurtech is gone a bit, and we have seen models that had higher CACs than premiums, that had portfolios with loss ratios that will never be profitable, or tech companies that had surprisingly little tech, and investors also did realize this and are now mandating really quality for the companies, having real improvements and real business impact. So how did companies react to this? we asked insurtechs, but also a bit broader in the last 2-3 months of what they are doing. And the results we got were quite positive. So many, if not all, and probably also many of you in the room, are already reacting to the new situation. So the broad majority increased customer acquisition efforts. They also accelerated product launches, but they also sometimes let go a lot of their employees to improve run rate and resilience. And finally, many are preparing to make some big moves now, like M&A, trying to merge with competitors, trying to take over smaller ones, and really take advantage of the current situation. And that is surprisingly also what we found was quite good in the last crisis. So when you look to 2007, 2008, those who did bold moves back then, who did M&A on a much bigger scale, were the ones who were through-cycle performers and also excelled then in the recovery phase. And let's not forget, this is not only for those who are already in the market, but the crisis can also be a good time to found new companies. While this might sound counterintuitive, when you see all these brilliant companies that we all know today, all superstar companies with billions of dollars of valuation, Airbnb, Uber, really across industries, they were all founded between 2008 and 2010. And even Microsoft was founded in the midst of the oil crisis with unprecedented economic conditions that we had back then. And I think many of us, I hope also in the room today, are still quite positive on the space overall. So our friends from Lakestar did an analysis of what they do think is the contribution of new growth companies, startups, scale-up to the overall economy, and they come to the conclusion that there is a significant contribution from the innovation ecosystem to be done from growth companies, and not only from the incumbents, so really seeing the value creation that can be done. So to close, the question is a bit, what are companies doing today and what do they need to do to succeed? While there is, of course, the long-term value creation opportunity that also requires to come through the crisis a bit, and we see 4 things currently happening right now. One is cash flow is definitely a premium right now. So while interest rates are increasing, cost of capital are also increasing for investors. And as I have shown, the market is not easy. So it's a bit CFO time right now and keeping a bit the hand on the money that is already in the company. Then from a strategic point of view, both to already existing companies in the market, but also those who are founded newly, the mantra of growth at all costs is largely vanished. You still see some of the companies that are still trying to find a business model, but it's largely shifting towards value, towards path to profitability, and real quality and substance. Third, there is a mandate for also more operating leverage. So investors are quite prone to fund models that can show clear scale advantages. So meaning if you have a traditional insurance model and both your loss ratio just continues with when you grow and also the acquisition costs don't really scale, then it's not a favorable term for investors. And finally, and I think we have seen it even more in the fintech space, is there is an increasing bar on operational maturity. So regulators quite regularly stepping in right now in Germany and across Europe, demanding to improve risk processes, and investors are doing the same. So to end, I would like to leave you with one quote which I found quite interesting from the Amazon founder. So many people think about, especially in times of change like this, what is changing in the market? What are the new trends? What are the new opportunities? What are the new challenges? But you could also turn it around and think about what does not change. For example, also in 10 years, people, and also in the insurance industry, customers will demand low prices. They will demand to have good B2B, partners will demand to have good and seamless technology, and consumers want insurers to be there when they have a claim. This will not change. And that does not mean that we in the room don't need to do innovation, but that means to focus our efforts also on the things that will last across the new era. and that we can also afford to invest into these value pockets. So thank you for having me, and enjoy the rest of the day.